Close your eyes. In June 2021, a DeFi protocol called Iron Finance lost $2 billion in 4 hours. The governance token that backed its stablecoin fell from $60 to essentially zero in a single afternoon. 11 months later, Terra would repeat the same collapse at 40 times the scale. The mechanism was documented. The warning was published. The world read it and built it again anyway. Imagine watching $2 billion disappear in 4 hours. Not slowly, not in stages spread across days or weeks, but in a single afternoon, with a speed that defeated every attempt to understand what was happening before it was too late. Imagine watching the price of a token that had been valued at $60 fall to zero in the time it takes to eat lunch. Imagine reading the on-chain data in real time, watching wallets draining, watching the mechanisms that were supposed to maintain stability accelerating the collapse they were designed to prevent, and understanding, too late for it to matter, exactly what you were witnessing. The speed is the first thing that distinguishes DeFi financial crises from the bank runs of traditional finance. In the history of banking, the bank run, the collective rush of depositors to withdraw their funds before the bank fails, was a force that unfolded over hours or days, constrained by the operating hours of branches, the physical reality of queuing, the time required for information to travel through a world without instant communication. The most famous bank runs of the 20th century, the Great Depression collapses, the Northern Rock crisis in 2007, the IndyMac failure in 2008, all gave regulators and deposit insurers enough time to observe what was happening and attempt intervention. The FDIC was designed precisely for this gap between the beginning of a bank run and its completion. Blockchain transactions process continuously, around the clock, with no operating hours, no queues, and no regulatory backstop with access to emergency liquidity. The speed of an algorithmic DeFi bank run is the speed of the blockchain itself. On Polygon, transactions confirm in seconds. A participant who recognized the Titan collapse in its first minutes and submitted a redemption transaction was competing with hundreds of other participants who had recognized the same thing at nearly the same moment, and all of their transactions were being processed in the same few blocks of the blockchain, with no mechanism to slow them or to inject stability. The speed that made DeFi attractive, the instant finality, the 24-hour market, the elimination of settlement delays, also made the bank run possible at a pace that no human oversight process could match. Understanding this speed is essential to understanding why the Iron Finance collapse matters beyond its own financial losses. The scenario it demonstrated, a design stability mechanism that becomes a destabilizing accelerant under stress, operating at blockchain speed, is not an artifact of Iron Finance's design. It is a general property of any DeFi system that contains feedback loops between a volatile asset and a stability mechanism. The blockchain's speed means that when those loops activate, they complete before any intervention is possible. This happened on June 16, 2021, to a protocol called Iron Finance, operating on the Polygon blockchain. In the early afternoon, Titan, the token that underpinned Iron Finance's algorithmic stablecoin mechanism, lost essentially all of its value in a matter of hours. The event was described by Iron Finance's own team in a post-mortem published the same day as the world's first large-scale crypto bank run. That description was accurate in its mechanics, though not in its implication that the event was merely an unprecedented accident rather than a predictable consequence of the particular design choices the protocol had made. The story of Iron Finance matters for reasons that extend beyond its own collapse. It happened more than a year before the much larger and more famous collapse of Terra, the algorithmic stablecoin catastrophe that wiped out $40 billion in May 2022. Iron Finance was the proof of concept for what Terra's mechanism could do under stress, the warning that was available to anyone who was paying attention. Iron Finance's relationship to Terra Luna is the relationship of the forgotten dress rehearsal to the opening night catastrophe. The mechanism was identical. A stablecoin whose stability depended on a volatile governance token, a feedback loop that activated under selling pressure, a death spiral that accelerated to completion before intervention was possible. The collapse of Iron Finance was documented, analyzed, and discussed in June 2021. The lessons were clear. The lesson was not absorbed, or was absorbed by individuals, but not by the institutional logic of a DeFi market in full bull market expansion, where the memory of the last failure is consistently shorter than the optimism about the next opportunity. 11 months after Iron Finance, Terra Luna launched with essentially the same mechanism at 100 times the scale. And it was attended, in a way that made Iron Finance famous far beyond the size of the loss, by a celebrity endorsement from one of the most prominent investors in the world, whose very public account of his own losses made this DeFi disaster legible to an audience far larger than the DeFi community itself. The summer of 2021 was a period of extraordinary optimism in decentralized finance, a period that, in retrospect, had the precise quality of a speculative peak, without the participants knowing they were at one. Total value locked across DeFi had recently passed $100 billion for the first time. New protocols were launching weekly, each promising some novel improvement on the lending, trading, and yield generation mechanisms that had defined the space's first generation. Yield farming, the practice of depositing assets into DeFi protocols in exchange for governance token rewards, had created an environment where double and triple-digit annual returns were advertised as normal, where the question was not whether returns would be high, but which protocol offered the highest. The market was, as markets sometimes are, temporarily divorced from any framework that would have assigned reasonable probabilities to adverse outcomes. In this context, the Iron Finance protocol's combination of partial USDC backing, governance token integration, and high-yield farming pools fit naturally into what participants expected DeFi to look like. The yield was high, but so was the yield everywhere else. The mechanism was novel, but so were all the mechanisms. The risk of a catastrophic feedback loop was present in the design, but identifying it required precisely the kind of adversarial thinking that bull markets tend to suppress. The imaginative act of asking what the worst plausible sequence of events would look like, and following its consequences through the system. In June 2021, most of the capital in DeFi was held by people who were not performing that analysis, or who were performing it and concluding that the probability of the worst case was low enough not to matter. They were wrong about the probability. In the next chapter, how Iron Finance's hybrid stablecoin design connected a freely floating governance token to a pegged dollar, and why that connection, intended to improve capital efficiency, created a feedback loop that would activate under selling pressure with devastating speed. Iron Finance was built on a distinct model for creating a stablecoin: partial collateralization. The dominant model for stablecoins at the time was either full collateralization, hold $1 for every token as USDC and USDT do, or algorithmic stabilization, use a smart contract to adjust supply based on price, without any collateral backing at all, as the early algorithmic experiments tried. Iron Finance attempted a hybrid. Its stablecoin IORN maintained its $1 peg through a combination of 75% USDC backing and 25% Titan backing. Titan was Iron Finance's own governance and utility token, not pegged to anything, freely floating in price, subject to market speculation. To mint one iron, you needed to provide 75 cents worth of USDC and 25 cents worth of Titan at current market prices. To redeem 1 iron, you receive the same proportions back, 75 cents of USDC and 25 cents of Titan. This mechanism created a direct link between the price of Titan and the stability of iron. When Titan's price was high and stable, the mechanism worked smoothly. Iron maintained its peg. Arbitrageurs could profit from small deviations above or below $1, and the system's design incentives aligned correctly. When Titan's price fell, however, the math began to work in the opposite direction. Frax Finance, a legitimate and more carefully designed, partially collateralized stablecoin protocol, had demonstrated that partial backing models could work, but Frax had multiple stability mechanisms that Iron Finance lacked, including dynamic adjustment of the collateral ratio and a more carefully designed incentive structure. Iron Finance's design was simpler and more vulnerable to the concrete feedback loop that would eventually destroy it. The protocol had launched on the Polygon network in April 2021, attracted by Polygon's low transaction fees, a fraction of a cent, versus the dollars that Ethereum mainnet transactions cost at the time, and by the rapidly growing DeFi ecosystem being built there. In its first 2 months of operation, it had attracted substantial liquidity, offering attractive yield on iron-related liquidity pools that drew farmers looking for yield in a bull market environment where every major DeFi protocol was offering rewards to attract capital. By June 2021, the protocol held more than $2 billion in total value. Titan's price had risen from initial trading around $0 to over $60, and the system appeared to be working. The high price of Titan and the high yields available on Iron Finance's liquidity pools had attracted a wave of capital that included some very sophisticated participants, including, by his own subsequent account, Mark Cuban. Understanding why the partial backing model was attractive requires understanding the capital efficiency argument that its proponents made. A fully collateralized stablecoin like USDC required $1 of collateral for every $1 of stablecoin in circulation. 100% capital efficiency by definition, but also a model that left no room for the collateral to generate additional yield. Over-collateralized models like MakerDAO's DAI required even more collateral than the stablecoin value, 150% or more, because the collateral itself was volatile and needed a buffer against price declines. The result was a model that was stable but capital inefficient, locking up more real resources than the stablecoins it produced. The partial backing model promised to do better. If 75 cents of stable USDC was enough to maintain confidence in the $1 value of an iron token, if the market believed the 25-cent Titan component would hold its value, then the protocol could produce $1 of stablecoin with only 75 cents of truly stable collateral. The remaining 25 cents of effective collateral came from confidence in Titan rather than from hard assets. This was more capital efficient, and it was also more fragile in a way that the capital efficiency argument did not fully illuminate. The 25 cents of Titan backing was not a fixed quantity of value, but a claim on a volatile asset whose value was itself partly a function of confidence in the protocol. If confidence wavered, the effective backing could fall below 75 cents before any protective mechanism could respond. The liquidity pools that attracted depositors in the weeks before the collapse were structured around iron and Titan in ways that created additional complexity in the system's risk profile. Yield farmers were not simply holding iron. They were providing liquidity in pools that contained Titan alongside iron, which meant that a decline in Titan's price reduced their position value directly and also reduced the stability of the iron they were holding. The interconnections between different pools and positions meant that a stress event in Titan would propagate through the ecosystem in multiple simultaneous channels, creating a more complex and harder to model cascade than a simple two-asset system would produce. Mark Cuban, billionaire entrepreneur, owner of the Dallas Mavericks basketball franchise, longtime technology investor, and frequent commentator on the crypto space, had become a vocal participant in DeFi in 2021. He was active on Twitter, discussing various protocols, sharing his positions, and offering opinions on the industry with the directness that had made him a prominent figure on the platform. He had written positively about Polygon and about several DeFi protocols building on it. In May and June 2021, Cuban was participating in Iron Finance. In a blog post published before the collapse, he had described his involvement in DeFi yield farming, including with Iron Finance's pools, in terms that conveyed genuine enthusiasm, not just for the returns, but for the intellectual interest of the protocols themselves. He was staking Titan and earning yield. When the collapse happened on June 16th, Cuban was among the affected participants. He was not devastated financially. His losses in Titan were a small fraction of his net worth, and he acknowledged this explicitly. But his willingness to discuss what had happened publicly, specifically that he had been in Iron Finance, that he had not fully understood the risks, and that the collapse had illustrated something important about DeFi, made the event visible to audiences who would not otherwise have followed DeFi news. Cuban's post-collapse commentary was, by the standards of high-profile DeFi participants who typically go quiet after losses, unusually candid. He called for better disclosure and risk labeling in DeFi. He engaged in extended Twitter discussions about what had happened and why. He used the phrase, "I got hit like everyone else," in a way that, for a billionaire who had built his reputation partly on analytical toughness, was a notable admission. The Iron Finance collapse became, in the mainstream financial press, the story it became largely because of Cuban's involvement and his subsequent willingness to talk about it. The media coverage generated by Cuban's involvement introduced the DeFi bank run concept to audiences who were not following blockchain transactions or DeFi protocol mechanics. Outlets that would not normally cover the collapse of a relatively small DeFi protocol on the Polygon network ran stories about a billionaire basketball team owner losing money in a crypto experiment gone wrong. These stories almost universally focused on the Cuban angle rather than the mechanism, which was a journalistic choice that made the story accessible and somewhat missed the more important point. Not that a celebrity had lost money, but that a targeted failure mode had been demonstrated that had direct implications for much larger subsequent projects. The way that Cuban framed his losses was revealing in a way he perhaps did not intend. He was clear that he had not fully understood the risks, that he had been farming yield in Iron Finance's pools without a complete model of what would happen if large holders began selling Titan simultaneously. This admission, from someone whose public profile included extensive technology investment experience and a reputation for analytical rigor, made a point more effectively than any regulatory warning could have. DeFi protocols can be complex enough that sophisticated investors do not fully understand their risk profiles. If that was true for Mark Cuban, it was almost certainly true for the vast majority of the protocol's retail participants. The Cuban episode was also a data point about the role of celebrity in DeFi capital flows. His earlier positive commentary about Polygon and DeFi protocols had, according to subsequent analyses, contributed to increased interest in those projects. His participation in Iron Finance's pools was visible on-chain and had been noted by DeFi community members who treated high-profile wallet activity as a signal. The social dynamics of DeFi, where influencer attention and whale wallet movements are monitored in real time and factored into investment decisions, meant that Cuban's presence in the protocol had attracted additional capital that would not otherwise have been there. and whose withdrawal accelerated the collapse when the initial selling began. The particular sequence of events on June 16, 2021, unfolded with the relentless logic of a mechanism that had been carefully designed for stability, and that, under the deliberate pressure of a sudden large withdrawal, revealed a vulnerability that was not obvious from the outside. In the early hours of June 16th, some large holders of Titan, whales in the DeFi vocabulary, began selling their positions. The detailed reason for the initial sell pressure is not clearly established. It may have been profit-taking after a significant run-up in Titan's price. It may have been concern about risks that sophisticated analysts had identified. It may have been simply the decision of investors whose positions had grown large enough that they needed to rebalance. Whatever the reason, the selling was large enough to be visible on-chain, and visible selling by large wallets in DeFi frequently triggers responses from other holders who interpret the whale behavior as a signal that something is wrong. Titan's price began to fall. Here, the feedback loop that the protocol's design had inadvertently created began to operate. As Titan fell, the collateral backing each iron token became less valuable. Holders of iron who were paying attention recognized that the protocol's ability to maintain the $1 peg depended on Titan's price, and that Titan was falling. The rational response for a risk-aware iron holder was to redeem iron for its collateral, 75 cents of USDC plus 25 cents of Titan at current prices before Titan fell further. But redeeming iron required the protocol to sell Titan to provide the redemption proceeds, which increased selling pressure on Titan, which further reduced the collateral backing iron, which triggered more redemptions. This is a bank run in its pure form. Not a bank run in a metaphorical sense, but a mechanically precise replay of the dynamic that causes bank runs in traditional finance. When depositors believe that a bank might fail and rush to withdraw, their withdrawals can cause the failure they feared. The mechanism at Iron Finance was identical, operating at the speed of blockchain transactions rather than the speed of queues at teller windows. Traditional finance developed its primary bank-run defense, deposit insurance, precisely because the dynamic of self-fulfilling panic is so destructive when it activates. The FDIC's deposit guarantee breaks the logic of the bank run by making the rational response to any level of concern about a bank the same. There is no incentive to rush to withdraw because your deposits are guaranteed regardless of whether the bank fails. By eliminating the first-mover advantage of early withdrawal, deposit insurance eliminates the game theory of the bank run itself. The guarantee need not even be invoked most of the time. Its existence changes the calculation that produces bank runs in the first place. DeFi has no equivalent. The redemption mechanism that iron holders used was not guaranteed by any authority with the ability to inject liquidity. It was backed only by the assets in the protocol's smart contracts, USDC and Titan's value was collapsing at the same time. The people who redeemed earliest received the most USDC per redemption because Titan had not yet fallen as far. The people who redeemed later received less USDC because the protocol had been depleted, and the Titan component they received was worth progressively less with each passing block. This first-mover advantage in redemption made the bank run exactly as rational as the traditional bank run, and eliminated any mechanism by which cooperation could have prevented it. Even participants who understood the mechanism and would have preferred a coordinated slow withdrawal that allowed Titan's price to stabilize had no way to implement that coordination against the individual rationality of every other participant who was simultaneously calculating their best exit. The absence of deposit insurance or equivalent backstop mechanisms in DeFi is not a design oversight. It is a consequence of the design philosophy. Trustless, autonomous, without reliance on any centralized authority. A deposit guarantee requires a guarantor, an entity with resources sufficient to cover losses and authority to enforce the guarantee. DeFi's commitment to decentralization and trustlessness is structurally incompatible with the existence of such a guarantor. This is one of the most important tensions in the DeFi project. The features that make it trustless also make it vulnerable to the same collective panic dynamics that traditional finance developed deposit insurance to address. The collapse was rapid because the architecture that was supposed to provide stability, the redemption mechanism, the arbitrage opportunities, the Treasury's USDC backing, all worked as designed, but operated in directions that accelerated rather than arrested the decline. Arbitrageurs who should have bought iron below its peg, profit opportunity, buy at $0.98, redeem for $1 of collateral, were instead receiving Titan as part of their collateral redemption, and Titan was falling fast enough that the arbitrage was not profitable. The USDC reserve that was supposed to backstop iron was being rapidly depleted by redemptions. The on-chain record of the collapse is extraordinarily detailed. Every transaction, every wallet movement, every redemption and liquidation preserved permanently on the Polygon blockchain and available to anyone who wants to reconstruct the sequence. Blockchain analysts who reviewed the data in the days and weeks after the event identified the particular wallets that initiated the initial large cells of Titan, traced the cascade as it spread through the ecosystem, and documented the exact timing of each stage of the collapse. This post hoc analysis could not save anyone who had been in the protocol during the afternoon of June 16th, but it produced a granular understanding of how the feedback loop operated in practice that was valuable for subsequent research. Before tracing those mechanics in detail, it is worth pausing on what made the failure so difficult to see coming and so impossible to stop once it started. Imagine a car whose brakes, under normal conditions, slow it reliably, but whose braking system, under one precise set of conditions, pumps fuel to the engine instead of pressure to the brakes. In ordinary driving, the system works. In that one edge case, the act of braking accelerates you. The driver pressing the brake pedal harder only makes things worse. This is what happened at Iron Finance. The mechanism designed to maintain iron's dollar peg became, under stress, the mechanism that destroyed it. Every redemption that should have stabilized the system instead accelerated the collapse, because every redemption increased selling pressure on Titan, and selling pressure on Titan reduced the value of the next redemption, which created more urgency to redeem before things got worse. The redemption mechanism's role in the collapse deserves particular attention because it illustrates a counterintuitive truth about financial system design. Features that provide stability under normal conditions can become destabilizing under stress. The redemption mechanism, the ability to return iron to the protocol and receive USDC and Titan in exchange, existed to provide a floor under iron's price. If iron fell below $1, arbitrageurs could buy it cheap and redeem it for $1's worth of collateral, locking in a profit. This mechanism worked exactly as intended when the decline in iron was small and Titan was stable. It failed when Titan was falling, because each redemption not only depleted the USDC reserve, but added to Titan's selling pressure, accelerating the very decline that made iron's price fall further. Blockchain analytics also documented the behavior of the yield farming pools during the collapse. Liquidity providers who had deposited into Iron Titan pools found that the declining price of Titan was reducing their position values in real time, creating additional incentive to exit. The automated mechanisms that DeFi platforms use to rebalance pool compositions, maintaining constant ratios between pool assets, were adjusting the pool's Titan holdings upward as Titan's price fell, in effect buying more Titan to maintain the pool ratio at precisely the moment when the market signal was unambiguously to sell. These mechanical rebalancing operations provided temporary support for Titan's price, but also ensured that liquidity providers who waited to exit would do so, holding more Titan and less USDC than when they entered. By early afternoon, Titan had fallen from its recent high of approximately $60 to below $1. By later afternoon, it was below a cent. By evening, it was effectively zero, a price so low that the blockchain displayed it as zero in most interfaces, though in technical terms, some fraction of a cent of value remained. The fall from $60 to zero had taken less than 8 hours. The numbers involved were substantial for DeFi at that stage of its development. Roughly $2 billion in total value had been in the Iron Finance ecosystem the morning of June 16th, and by the end of the day, the Titan component of that value, roughly $1 billion, had been almost entirely wiped out. The USDC backing was depleted, but not entirely gone. Iron holders who had redeemed early received their 75% USDC component, but the 25% Titan component they received was now worthless. Late redeemers who had hoped to exit at better prices received progressively worse values as the protocol's USDC reserve ran down. Iron Finance's team published a post-mortem on the same day as the collapse. The document was remarkably candid about the mechanism of the failure, describing the bank-run dynamic accurately and acknowledging that the protocol had experienced something for which it had not been fully prepared. The team characterized what had happened as unprecedented. They were not wrong that no DeFi protocol had experienced a comparable event at this scale, while also acknowledging that with hindsight, the feedback loop was visible in the design. What the post-mortem did not do and could not do was address the broader question that the event raised: whether partially collateralized algorithmic stablecoins were fundamentally sound or fundamentally vulnerable to exactly this kind of collapse under any sufficiently adverse conditions. The Iron Finance team presented the collapse as a unique event, a set of circumstances that could be addressed by design improvements. The critics of the model argued that what had happened at Iron Finance was not a failure, but a demonstration of a general principle: that any stablecoin design that required participants to trust a volatile token as partial collateral would, under sufficient stress, fail in exactly this way. The protocol's USDC reserves at the time of the collapse were approximately $200 million, meaningful backing for the IRON tokens in circulation, but insufficient when redemptions began occurring faster than the mechanism could process them at stable prices. The queue of redemption requests that built during the afternoon created additional chaos. Participants who submitted redemption transactions and waited for them to be processed found that by the time their transaction was confirmed, the Titan they were receiving as part of the collateral had declined further, and the effective value of their redemption was less than it had appeared when they initiated it. The legal status of Iron Finance after the collapse was also left unresolved by the post-mortem. The protocol's code had functioned as specified. The team had not misrepresented the backing ratio or the mechanism in any verifiably false way. Whether the failure to adequately communicate the bank-run risk in the protocol's documentation constituted misleading disclosure was a question that regulators in 2021 were not equipped to answer under existing frameworks, not because the question wasn't worth asking, but because the frameworks that would have answered it did not yet exist for DeFi. The people who lost money in Titan could document their losses on-chain, but there was no mechanism through which those losses could be compensated or any party held accountable. The protocol had worked as specified. That the specification had a catastrophic vulnerability was not, in the legal environment of 2021, anyone's actionable responsibility. The community response in the days after the collapse included both grief and something approaching philosophical recalibration. Users who had been enthusiastic participants in Iron Finance's yield farming, who had understood the protocol as an innovative and well-constructed system, had to integrate the fact that their understanding had been incomplete in a way that had real financial consequences. Some left DeFi entirely. Some stayed and analyzed what had happened more carefully, developing a more adversarial relationship with future protocols' designs. The community that gathered around Iron Finance's collapse produced some of the better analytical writing of that era about DeFi's structural vulnerabilities, partly because the mechanism was so clear, and partly because the clarity came at a cost that motivated the people who experienced it to explain what had happened as precisely as they could. The Iron Finance collapse happened on June 16, 2021. The Terra Luna collapse, a structurally similar event, though operating through a different clear mechanism and at a scale more than 40 times larger, happened on May 9 to 12, 2022, 11 months later. In the 11 months between these events, the Terra ecosystem grew from a significant but not dominant DeFi presence to one of the largest in the space. Terra's UST stablecoin reached a market capitalization of $18 billion. Luna, the volatile token that played an analogous role to Titan in Terra's stability mechanism, reached prices above $100. Anchor Protocol, which offered 20% annual yield on UST deposits, accumulated billions of dollars in deposits from retail participants who had not examined or who had dismissed the concerns about whether the yield was sustainable. The parallels between Iron Finance and Terra were not invisible to the DeFi community. Post-mortems of Iron Finance, published in the weeks after its collapse, explicitly described the feedback loop that had destroyed it and noted that any design sharing similar properties would be vulnerable to similar failure under stress. Several researchers published analyses of Terra's mechanism that identified the same feedback dynamics and argued that Terra could experience a similar collapse. These analyses circulated in DeFi Twitter and DeFi research communities. Terra's founder, Do Kwon, was dismissive of these analyses. He was publicly combative toward critics, referring in one famous tweet to the 95% of analysts who believed Terra would fail as those who would die poor. He expressed confidence that Terra's distinct design, including a Bitcoin reserve being accumulated to backstop the peg, was fundamentally different from and more robust than other algorithmic stablecoin experiments. The community of enthusiastic UST and Luna holders, many of whom had significant financial interests in the protocol's success, tended to share his confidence and to treat the critics as either unsophisticated or operating in bad faith. When Terra's bank run began in May 2022, it followed a trajectory that was structurally very similar to Iron Finance's collapse. Large selling pressure on UST triggered the algorithmic mechanism that was supposed to restore the peg, minting Luna to buy UST, which flooded the market with Luna supply, which drove Luna's price lower, which increased the quantity of Luna that needed to be minted to stabilize UST, which drove Luna lower still. The spiral that Iron Finance had demonstrated in 4 hours on a $2 billion protocol was replicated over 4 days on a $40 billion one. The Iron Finance warning had been available. The mechanism it demonstrated had been described accurately. The scale of the subsequent failure suggests that the warning was not taken seriously enough by the people who needed to hear it. The sociology of why the warning was not heard is as instructive as the mechanics of the failure itself. The DeFi community that evaluated Terra in 2021 and 2022 had access to the Iron Finance post-mortem. The structural similarities between the two designs were noted by researchers who published their analyses publicly. But the community evaluating Terra was not a dispassionate group of analysts. It was a community with significant financial stakes in Terra's success. a charismatic and combative founder who framed criticism as intellectual deficiency, and a product, the 20% yield on Anchor Protocol, that was extremely attractive to participants who were not thinking about what would happen when the yield became unsustainable. The bias toward optimism in communities with financial stakes is not a DeFi particular phenomenon. It appears in every speculative environment. The precise DeFi version of it had several amplifying features. The pseudonymity of many participants, which made public criticism socially costly in ways that affected perceived credibility. The real-time nature of on-chain data, which showed Luna's price rising and Anchor's deposits growing, providing constant positive feedback. And the concrete culture of the Terra community, which had developed, like Olympus Deo's community before it, social norms that treated skepticism as apostasy. The people who understood the iron finance warning were not wrong. They were simply not the people whose opinions shaped the allocation of the next $40 billion. The tragedy of the Terra Luna collapse, which produced genuine financial devastation for millions of retail investors globally, many of whom had allocated retirement savings to Anchor Protocol on the basis of the 20% yield, is proportional to the scale of what could have been known in advance. The mechanism was demonstrated in June 2021, 11 months before it operated at 40 times the scale. The warning was not abstract or theoretical. It was a completed experiment, documented on a public blockchain, with billions of dollars in losses as its data. That this warning was insufficient to prevent a 40 times larger repetition says something important about the structural conditions that govern how information about financial risks circulates and influences behavior. The iron finance collapse attracted immediate attention from financial regulators who had been watching DeFi's development with increasing concern. Mark Cuban, in his post-collapse commentary, had called for regulatory frameworks that would require better risk disclosure for DeFi participants. A somewhat surprising position from a libertarian-leaning entrepreneur, but one that reflected his targeted experience of being in a protocol whose risks he had not fully understood. The Treasury Department and the Federal Reserve, in reports issued in 2021 and 2022, cited algorithmic stablecoin instability, explicitly referencing the iron finance event as one of the primary risks in the DeFi space. The Financial Stability Board, an international body coordinating regulatory approaches to financial risk, included algorithmic stablecoins in its category of DeFi mechanisms warranting urgent attention. Gary Gensler, then the chair of the SEC, referenced the iron finance and Terra collapses in congressional testimony, arguing for stablecoin regulation. The regulatory response to these events eventually produced, in multiple jurisdictions, proposed frameworks for stablecoin oversight that distinguished between asset-backed stablecoins, which would be permitted under regulated conditions, and algorithmic stablecoins, which would face much stricter treatment or outright prohibition. The European Union's MiCA regulations, implemented in 2024, effectively prohibited new algorithmic stablecoin designs that did not meet particular backing requirements. Several U.S. legislative proposals included similar distinctions. The people who had lost money in iron finance did not receive any regulatory remedy. The protocol's smart contracts had operated exactly as designed. The design's vulnerability was a fact about the code, not a fraud perpetrated by any identifiable person on identifiable victims. The losses were real, but the legal framework for addressing them did not exist in 2021 and was still being constructed in 2024. The regulatory attention catalyzed by iron finance and accelerated by the Terra collapse produced a conceptual framework that has since shaped how regulators in multiple jurisdictions distinguish between acceptable and unacceptable stablecoin designs. The core distinction that emerged was between payment stablecoins, tokens backed one-to-one by high-quality liquid assets designed to function as dollar substitutes for transactions, and algorithmic stablecoins, tokens that relied on algorithmic mechanisms, governance tokens, or other non-asset-backed means to maintain stability. The former category was treated as potentially regulatable under existing or modified financial frameworks. The latter was treated with considerably more suspicion, with some regulatory proposals effectively prohibiting them. The SEC's increasing focus on DeFi protocols as potential securities issuers also extended to algorithmic stablecoins in ways that their creators had not anticipated. Titan and Luna, the governance tokens that served as partial backing for Iron and UST respectively, had price trajectories that looked like speculative asset sets rather than utility tokens. They went up when the protocol grew and down when it contracted, creating the same kind of investment characteristic that securities law had been designed to regulate. Whether these tokens were securities under the Howey test, the legal standard for determining when an investment contract exists, was a question that the SEC indicated it would pursue through enforcement rather than guidance, creating an uncertain environment for any subsequent protocol designer considering a similar model. The practical effect of this regulatory attention has been to significantly reduce the number of new algorithmic stablecoin experiments launched after 2022. The combination of Terra's spectacular failure, increased regulatory scrutiny, and a broader DeFi market downturn created conditions unfavorable to the kind of ambitious monetary experiments that Iron Finance and Terra represented. Whether this reduction represents a genuine improvement in the risk environment for DeFi participants, or merely a displacement of risk toward mechanisms that regulatory frameworks have not yet identified, is an open question. Financial innovation has historically found ways to reconstitute the same fundamental risks in new forms when existing forms become socially or legally unacceptable. Despite the Iron Finance collapse, algorithmic and partially collateralized stablecoin experiments continued in the years following. The designers of subsequent protocols pointed to Iron Finance as a lesson, something to be studied, something to be designed around, something that demonstrated deliberate failure modes that could be avoided with better construction. Some of these subsequent experiments have indeed avoided the detailed feedback loop that destroyed Titan. Some have found different failure modes. None has achieved the scale or adoption of the dollar-backed stablecoins whose centralization they were designed to replace. The fundamental challenge of a decentralized stablecoin, one that maintains a stable value without any centralized entity holding equivalent collateral, remains unsolved in a way that is satisfying across all the relevant dimensions simultaneously. Frax Finance has maintained its peg through multiple market cycles with a design more robust than Iron Finance's. MakerDAO's DAI, backed primarily by over-collateralized positions in ETH and other assets, has maintained stability through periods of extreme volatility. But these successes have come at costs: reduced capital efficiency, governance complexity, incomplete decentralization, that mean they do not fully achieve the original vision of the algorithmic stablecoin. The Iron Finance story sits in the DeFi historical record as a clear demonstration of what happens when a partially backed design meets adverse conditions. The speed of the collapse, $2 billion to approximately zero in a single afternoon, was at the time startling, though subsequent events in the crypto space have made even larger single-day losses seem familiar. The mechanism demonstrated remains relevant. Any design that relies on a volatile token as partial backing for a stable token, and that allows the two to interact through a redemption mechanism, has a built-in feedback loop that stress can activate. The stablecoin landscape after Iron Finance and Terra has been considerably reshaped by what those events demonstrated. The dominant stablecoins, USDC, USDT, and DAI, All survived the post-Terra period because they were backed by real assets in ways that Iron Finance and Terra were not. USDC and USDT maintained their pegs because every dollar of each was backed by approximately $1 of fiat assets and short-term U.S. government securities held in regulated financial institutions. DeFi maintained its peg through over-collateralization, requiring borrowers to deposit more ETH or other collateral than the DeFi they minted, providing a buffer against price declines. These models are not elegant. They require more capital than the algorithmic approach promises, but they are stable in ways that matter when markets are not. Frax Finance's survival as a partially backed stablecoin through the same period is instructive because it demonstrates that the partial backing approach can work when designed more carefully than Iron Finance's version. Frax's design included dynamic adjustment of its collateral ratio. When market conditions were favorable, the ratio could be reduced. When stress appeared, the ratio was automatically increased, providing more hard backing at the moment it was most needed. It included a price stability module that could deploy protocol-owned stablecoins to defend the peg, and it operated with a treasury large enough to backstop significant redemption pressure without becoming insolvent. Frax is not the same as USDC's simplicity, but it demonstrates that the space between full collateralization and the dangerous instability of Iron Finance's design is navigable. New entrant designs after Terra have largely attempted to occupy that middle ground, offering some degree of capital efficiency beyond full collateralization without accepting the extreme feedback loop vulnerability of the Titan-style design. Whether any of these designs has successfully solved the fundamental problem remains to be demonstrated across multiple market cycles and multiple stress scenarios. The history of stablecoin design in DeFi is short enough that what has not yet been stress tested has not yet been proven robust. The warning was clear. The demonstration was complete. What happened next is a different story, but it is a story that Iron Finance made available to anyone who was willing to read it. The deeper lesson of Iron Finance is not specifically about algorithmic stablecoins. It is about a general principle, the difference between mechanisms that are stable under normal conditions and mechanisms that are stable under all conditions. The distinction matters because financial systems regularly encounter conditions that are outside the normal range. Markets experience stress events, large holders make large decisions, cascades can be triggered by relatively small initial perturbations if the system has the right or wrong feedback properties. A mechanism that works perfectly for 2 months and then fails catastrophically in an afternoon is not a stable mechanism in any sense that matters for participants who did not exit in time. Iron Finance's partial backing was not a fraud. The protocol's mechanics were disclosed. The team was not secretly aware of the vulnerability and hiding it. The design was presented as a genuine innovation in stablecoin architecture, and the team believed in it. What the design lacked was the kind of adversarial stress testing, imagining precise sequences of events and tracing their consequences through the system's mechanisms that would have revealed the bank-run vulnerability before it was encountered in practice. The adversarial testing gap in DeFi protocol design is a systematic problem that goes beyond any single protocol. When a traditional financial institution designs a new product, it passes through regulatory review that includes stress testing requirements, prescribed scenarios of market decline, liquidity crisis, and correlated failure that the product must be shown to survive. The regulatory requirement exists because regulators have observed over decades of financial history that complex financial products fail in ways their designers did not anticipate, and that the consequences of those failures extend beyond the immediate parties to the broader financial system. The stress test is a mandatory act of adversarial imagination. DeFi has no equivalent mandatory process. Protocols are deployed after code audits that focus primarily on whether the code does what it claims to do, not whether what it claims to do is robust to adversarial scenarios. The bug bounty programs that supplement audits reward findings of code vulnerabilities, but not findings of economic design vulnerabilities. A distinction that matters because Iron Finance's failure was not a code vulnerability. The code did exactly what it was supposed to do. The vulnerability was in the economic design, in the interaction between correct components under the wrong conditions. The DeFi security community has, since Iron Finance and Terra, developed more sophisticated frameworks for economic security analysis. Firms that specialize in DeFi security now offer services that explicitly address economic attack scenarios, simulating large-scale market movements, modeling cascading liquidations, analyzing feedback loops under stress. These services are more expensive and more time-consuming than code audits, and their adoption is not uniform across the industry. The protocols that are most likely to skip them are, predictably, the ones operating with the most ambitious designs and the least margin for error. The same risk profile that Iron Finance exhibited. The lesson Iron Finance offers to protocol designers is not about any single mechanism. It is about the category of failure that emerges when you build a system that works well under normal conditions without asking what it does under extreme ones. Normal conditions are not the conditions that matter for financial system design. Extreme conditions are. Financial systems are tested not by their behavior when markets are orderly, but by their behavior when markets are not. The design of a robust financial protocol requires imagining the worst plausible sequence of events and building for that sequence, even if it seems unlikely, because the consequences of failing to build for it are catastrophic and irreversible. This is a broader challenge in the construction of financial systems. The particular failure modes of complex systems are often invisible until they are triggered, because they emerge from interactions between mechanisms that each function correctly in isolation. USDC backing was functioning correctly. The redemption mechanism was functioning correctly. The Titan supply mechanism was functioning correctly. What failed was the emergent behavior when these mechanisms interacted under the clear condition of simultaneous large-scale redemption pressure. Building financial systems that are robust to these emergent failures requires a different kind of engineering culture, one that treats adversarial scenarios not as unlikely edge cases, but as central design requirements. The DeFi space, in the years following Iron Finance and Terra, has developed a more sophisticated understanding of these requirements. Audit firms have expanded their analysis frameworks to include economic attack scenarios alongside code vulnerabilities. Research groups have developed formal models of DeFi protocol stability under stress. The space is, slowly and expensively, learning the lessons that traditional finance learned over centuries of bank runs and financial crises. Iron Finance paid for one of those lessons. $2 billion in 4 hours on a Wednesday afternoon in June 2021. The question of who is responsible for losses in a protocol that worked as specified, but was designed with a fatal vulnerability, is one that financial law has not resolved and may not resolve cleanly. In traditional finance, the concepts of fiduciary duty, securities disclosure requirements, and investor protection law create a framework in which the designers of financial instruments have defined obligations to the people who use them. They must disclose material risks. They must not engage in misleading marketing. They must act in the interests of their clients in certain defined contexts. These obligations exist because experience demonstrated, over many financial crises, that information asymmetry between financial instrument designers and investors produces systematic harm that markets alone do not correct. DeFi's ideological framework resists this kind of regulatory structure. The code is law, philosophy holds that the disclosed mechanics of a smart contract constitute full disclosure, that anyone who uses the protocol has accepted responsibility for understanding how it works, and that the outcomes produced by the code are by definition correct. This philosophy has a certain internal consistency and appeals to participants who are frustrated with the paternalism of traditional financial regulation. It also produces environments in which people lose their life savings to mechanisms whose failure modes were foreseeable but not disclosed in the documentation. The resolution of this tension between DeFi's commitment to trustless operation without regulatory overhead and the traditional finance insight that regulation exists for good reasons that experience has validated is the central policy question of the DeFi regulatory era that is currently underway. Iron finance is one of the case studies that regulators cite when arguing that self-regulation and code disclosure are insufficient, that the people most harmed by DeFi failures are often those with the least capacity to perform independent technical analysis, and that the public interest in financial stability justifies some degree of oversight even in decentralized systems. The DeFi community's response to this argument is complicated. The people who built Iron Finance believed in what they were building. The people who lost money in it have more reason than most to be skeptical of the argument that the market would have sorted it out without regulation. The people who designed Terra's mechanism after Iron Finance's warning had been published were aware of the risk. That awareness was not sufficient. Whether regulation would have been sufficient is a counterfactual that cannot be tested. What can be said is that the existing mechanisms, code audits, community scrutiny, voluntary disclosure, were demonstrably insufficient in Iron Finance's case and in Terra's, and that more than $60 billion of investor losses across both events constitutes a data point that demands some response. Close your eyes again if they have opened in the dark. The Titan token's price chart from June 16, 2021 still exists on every blockchain data service that tracks it. A line that rises steadily for weeks, reaches its peak, and then falls vertically to essentially nothing in a single column of data that represents a few hours of trading. It is one of the more striking charts in the history of financial markets. The fall is so steep and so complete that it looks almost unreal, like a graph from a textbook illustrating what exponential decay looks like, rather than a record of actual human financial decisions and their consequences. But it is a real record of real money and real people. The speed of that fall, the gap between the beginning of the afternoon and the end of it, when billions had become millions, and then thousands, and then close to nothing, is a distinct fact about what can happen when a design meets a condition it was not prepared for, in markets that operate without pause and without mercy for the gap between what we expected and what arrived. Let the night be quiet now. Let the lesson rest without requiring action. You are safe, you are still, rest.